The precipitous decline in iron ore prices throughout 2024 is not merely an economic indicator, it is a referendum on the faltering engine of global growth, and that is China. The steep 15% drop in prices and the sharp year-to-date contractions on the Singapore and Dalian exchanges expose a disconcerting truth. Stimulus can no longer mask the structural weaknesses plaguing the world's largest steel producer. The market's underwhelming response to Beijing's stimulus measures reveals the limits of state-led economic resuscitation in an era of diminishing returns. China's infrastructure-heavy stimulus, once a reliable lever for global commodities, now feels like a blunt instrument wielded against a far more complex economic malaise. While real estate and infrastructure spending provided a short-lived boost, they failed to address the deeper issues of overcapacity, tepid domestic demand, and a bloated inventory glut. President Xi Jinping's projection of 5% GDP growth, marginally outpacing the World Bank's forecast, offered only a temporary balm to jittery markets. The fundamental question persists: how much longer can China's slowing industrial sector prop up its waning economic might? The iron ore market is heading into 2025 like a ship weighed down by ballast, an oversupply glut that even robust demand would struggle to counterbalance. With Australian exports increasing and new projects coming online, the market is setting itself up for a prolonged period of depressed prices. This is not just an issue of market dynamics, but one of strategic miscalculation by producers. In chasing short-term gains, mining giants have ignored the warning signs of structural demand erosion. In China, which consumes nearly 70% of global seaborne iron ore, the steel sector's mixed performance further underscores the fragility of the industrial recovery. Marginal gains in rebar and wire rod were overshadowed by sharper declines across key benchmarks like hot-rolled coil and stainless steel. The modest gains in some segments reflect not market strength, but the temporary effects of government intervention. The underlying reality is grim, shrinking margins for steel makers and collapsing prices for essential inputs like coking coal signal sector in distress. It's tempting to view iron ore's decline as a China-centric issue, but this narrative ignores the global steel industry's interdependence. Europe, grappling with its own economic stagnation, offers little reprieve for iron ore exporters. India, heralded as the next growth engine, lacks the capacity to absorb the surplus left by China's slowdown. In this interconnected market, there is no safe harbor. The outlook for 2025 is bleak. With China's industrial demand set to contract further and global oversupply worsening, the iron ore market is bracing for a prolonged slump. The pressure on mining companies to curtail production will intensify, but any coordinated supply cuts are unlikely given the competitive dynamics of the industry. Instead, we can expect a race to the bottom, with smaller players exiting the market while the big miners tighten their belts. Government interventions, while politically expedient, will not suffice to restore balance. Without structural reforms in the steel and construction sectors, China's economic policies will remain akin to patching a sinking ship with duct tape. For miners, traders, and steelmakers, the message is clear: adapt or perish. The iron ore market's woes are a microcosm of larger global economic uncertainties. China's slowing growth, coupled with misguided production strategies and systemic oversupply, has created a perfect storm. This is not just a cyclical downturn, it is a moment of reckoning for an industry that must confront its over-reliance on an increasingly fragile economic superpower. The question for 2025 is not whether iron ore prices will rebound, but how low they will go before the market finally recalibrates.